He said that the goal here was to fill in some of the regulatory gaps and not necessarily to change the overall regulatory structure. We're going to now get some immediate reaction to the plan from Senator Mark Warner. He's a member of the Banking Committee, the Democrat from Virginia. Of course, this plan needs to be sold to members of Congress. Senator Warner, thanks for the time. Appreciate it. What's your initial take on what the president's outlined here?
Well, I think the administration's headed in the right direction. This ought to be a plan that ought to be thoroughly discussed. We know that if we got to get it right because the law of unintended consequences, this is so complicated, if we get it wrong, it could have enormous unintended consequences. I do have some concerns about some of the administration's proposals. I'm a little concerned, fairly concerned about their idea of putting systemic risk oversight further within the Federal Reserve. I think the Federal Reserve, that could pose potential conflict of interest. Federal Reserve has already got monetary policy. It's already extraordinarily powerful. I would prefer empowering a systemic risk council that would have the chairman of the Fed, chairman of the Treasury, chairman of our day-to-day prudential financial regulators, including the SEC, with an independent chair and an independent
Senator,
staff.
let me jump in on that if I. Let me jump in on that, and I'm sorry to cut you off because the outline, as I've seen it, we've obtained a document, the blueprint essentially, does call for a council as you described, but it also gives the Fed clearly more powers in dealing with systemic risk. Your worry specifically is that the Fed gets more of this power?
I'm worried that the Fed, that we ought to not make bigger regulatory entities so much bigger. I think there's a potential conflict of interest. I'd rather have that council not be an advisory council the way the administration's put together, but actually empower that council with an independent chair. You see, I think that the chairman of the Fed does a very good job with monetary policy. I think it's a different mindset to be a systemic risk regulator. I'd rather have an independent chair of that council with an independent staff that could actually draw up information from all the various regulatory agencies, not have any other responsibility in terms of monetary policy or day-to-day prudential regulation, have a systemic risk council with that independent staff having only one goal, and that one job is to make sure that we measure and try to get ahead of systemic risk.
Senator, there's already some criticism that this, while the president is addressing specific rule changes, trying to address some of these gaps, that he's not changing the architecture here. We have 8 regulatory agencies right now. At the end of the day, if this plan is approved, there's still going to be 8 regulatory agencies. Does there need to be consolidation, more consolidation?
Well, listen, I think that there ought to be at least examination of one end-to-end banking regulator for all depository institutions. I think we've seen in the last few years regulatory arbitrage by whether you're a SNL, a national bank, a local bank, a bank holding company. And I think we ought to look at least the possibility of saying if you're a depository institution, we ought to have a single regulator. I think we ought to keep the SEC obviously separate. I think we ought to make sure we have a separate resolution authority. I think there ought to be a lot of discussion about a resolution authority in terms of who it ought to be and how it ought to get funded. So this ought to be an area, though, where we can, it should not break down surely on partisan lines. This ought to be an area where we get the best advice possible, try to make sure we get it right. We've got one bite at the apple, my view is. This is one that if we get wrong, the unintended consequences in terms of the financial markets could be pretty devastating.
Sir, let me ask you while I've got you. I know you've also spoken to the Treasury Secretary, raised this issue about the TARP program, specifically the warrants that the government holds from TARP recipients. You've got some problems with, as these banks start to repay their TARP money, that they're getting these warrants back and maybe taxpayers aren't sharing the upside. Are you prepared to legislate in this area?
Well, Peter, Senator Jack Reed, a fellow member on the committee with me, and I have raised this issue. And we think that the taxpayer took an awful lot of risk when we invested in these financial institutions. And I'm happy to see these banks repay these funds. But as we try to appropriately get the government out of the bank's business, I think that's great. But I don't think as the banks pay back the TARP funds that we ought to be forced necessarily to basically to liquidate these warrants at this point, when I think there's still some potential upside for the taxpayer. We had to get into their business. We took that risk. I think we as a taxpayer ought to get that potential upside. Now, I think there are options rather than simply the government holding those warrants, which might keep us in their business. We could sell them to a third party and jointly share the upside. We could put them to a foundation. So I think there's other options where the banks can maintain their independence from further government intervention, but we, the taxpayer, could still get some upside. So I'd like to continue to work with the Secretary of the Treasury on that issue.
All right, Senator Mark Warner, Democrat of Virginia, member of the Banking Committee. Senator, thanks for the time. Betty, we'll send it back to you in Detroit.
Thank you.